There are only 4 ways to make millions in the stock market. And the first one is luck. But let's ignore this one because it is not repeatable and not deterministic. The second way to make millions is sheer talent, and there are a few smart geniuses out there who can pull it off. But you becoming one of those geniuses is just as difficult as becoming a soccer player who makes millions. Sure, those people exist, but even if you are wicked smart, you would have to grind for many years until you become good enough. And in my view, there are better ways to use those years and become rich by other means, but more on that later. The third way to make millions in the stock market is capital. Tons of it. The more money you have, the less risk you need to take in order to make millions. But this also means that you already need to be rich in order for this to work. And the last way to make millions in the stock market is time. So even if you just have a smaller sum to invest and only get a boring 7% return each year, that sum can grow into millions over time. But no one wants to spend 40 years waiting to become a millionaire. Those 4 ways of getting rich seem unachievable for most people. And how does this even relate to ETFs and index funds? Well, index funds combine the last 2 options into a single package. And all you have to do now is to bring in more and more money each year and see your investments grow faster and faster until you reach your goal. But that still takes many years and sounds so basic. Can't I just put in a little bit more effort and a little bit more research into my investment plan and then get much higher returns in a much shorter time? Yes, you can. But that is so difficult that in my view, I would rather stick with index funds and focus on other ways to bring in more money. When I just started investing, I thought the only way to make money was to become a smart trader. All the information I found on the internet was about trading. How to become the best trader. Trading this, trading that. And it took me a long time of researching and learning to understand how difficult this is. Let me elaborate. Let's take the S&P 500 over the last 2 decades. By just buying shares worth $10,000 and holding them for 20 years, you would have ended up with $63,000. Now, instead assume that you have tried to trade during the same 20-year time period. And let's imagine that you have missed out on just the best 10 days during these 2 entire decades. In that case, you would have ended up with only $29,000. That's half the money. Let that sink in. Just doing nothing for 20 years would have yielded you $63,000, which is roughly twice as much. And by missing out on the best 20 days, this sum will decrease to $17,000. Peter Lynch was managing a fund which yielded an average of 29% every single year. But most of his investors have lost money, because instead of just holding his awesome fund and doing nothing, they tried to be smart and kept buying and selling his fund. There are many statistics which show that most traders lose money. Because every time you buy or sell, there is a professional on the other side with much more experience who is trading against you. This is why I would rather focus on building a side business to bring in new money and then pick a simple index fund for storing this money. But what about picking stocks and holding them over a long time period? This is doable and can yield you better returns. But unless you already have a massive amount of capital to invest, picking stocks is more like a full-time hobby which will eat up a lot of your time. And that time can be spent more wisely somewhere else, in my opinion. With an index fund like the S&P 500 or the MSCI World, you are buying a wide range of very large companies. A massive company like Nvidia only makes up 3% of the MSCI World. So even if Nvidia collapses entirely, you will lose only 3%, in theory. And not only that, since most index funds usually contain the largest and most powerful companies in the world, you can benefit from the network effects of these companies. Apple has the capacity to outcompete smaller companies and even buy them out. It is much more likely for Apple to survive difficult times than it is for a smaller company. Therefore, there is less risk in large caps, which are the cornerstone of most large index funds. Buying an index fund is like betting on the entire market doing well and worrying less about individual companies. But does this mean there is no risk at all? Of course there is risk. Just look at how the S&P 500 crashed during Corona, or during the 2008 financial crisis, or during every other crisis. But if you zoom out, you will see that the market has always recovered. So if you would have bought right at the top before the crash, just waiting a couple years would have brought you back to the original price. But is there a way to mitigate this risk? Yes. There is a technique called dollar cost averaging. This means that instead of buying everything at once, you are buying a little bit every week or every month. By doing so over a longer period of time, your buying price will average out. So it's like buying stocks for the average price. Over the long term, you will benefit from compound interest. But that effect only starts to become noticeable after surpassing the $100,000 mark. I have invested over $100,000 of my own money and have talked about it in the video which you see on the screen right now.